bond and money market funds were the best-selling funds in the UCITS market in 2024. Net sales of bond UCITS rose as central banks cut interest rates in 2024, with markets anticipating further easing. Money market fund inflows rose to a new record, supported by attractive short-term interest rates and their appeal as a cash alternative. Equity UCITS saw a notable rebound in net inflows, buoyant by robust stock market performance throughout the year. In contrast, multi-asset UCITS experienced net outflows for the second consecutive year.
Equity UCITS delivered an average return of 18.1% in 2024, more than double their 5-year average, driven by robust stock market growth. Thanks to higher interest rates, bond UCITS also performed well in 2024, with a return of 6.5%, more than 6 times the 5-year average. Multi-asset funds achieved an average return of 9.8% in 2024, and money market funds yielded 7.8%, higher than bond UCITS that year as a result of the inverted yield curve for much of the year.
It is sometimes argued that Europe has too many small funds, which fail to fully leverage economies of scale and efficiently manage fixed costs. Indeed, at end 2024, there were around 11,000 UCITS with less than 100 million under management. However, these small funds represented only 3% of the total UCITS market size, and their share is declining rapidly. In contrast, the proportion of larger funds, those over 1 billion and especially those over 10 billion, continues to rise, helped in recent years by the popularity of ETFs and money market funds.
Fund costs have come down across the board for all major long-term UCITS types. Equity UCITS saw their average costs gradually drop over the past years, declining by 20 basis points to 0.75% in 2024. Average costs of bond UCITS dropped by 8 basis points over the same period, down to 0.56%. Multi-asset UCITS remained pricier than other funds, but costs still decreased from 1.26% to 1.16%. With an average cost of just 0.17%, money market funds are significantly cheaper than long-term UCITS, although their fees edged up a little in recent years. These downward trends are likely to continue, fueled by increasing fee transparency and a growing competitive pressure between fund managers.
The share of US stocks in the asset allocation of equity UCITS rose above 50% in 2024, almost doubling from 26% in 2014. This shift reflects the strong performance of US stocks over recent years, driven in large part by the exceptional growth of major US technology companies. Another contributing factor was the growing investor demand for funds that track global indices, which are heavily weighted towards US equities. Likely, however, 2025 will finally see this trend reverse, as European stocks outperformed US ones in the first months of the year.
In 2023, investment funds faced growing competition from government bond issuances targeting domestic retail investors. In several EU countries, governments successfully attracted household savings by offering yields higher than bank deposits, often supported by tax incentives. In 2024, however, retail purchases of debt securities dropped, while fund acquisitions rose to €258 billion, the second highest level in the past decade. This confirms that European retail investors largely rely on investment funds to gain exposure to capital markets.